In spite of steady news flow, the markets have been quiet for several weeks now. Still, there's much to think about. The central banks measure, for example, how effective are they in the long term, or Chinese growth. And in the meantime, the US are still headed for the fiscal cliff. To talk about this, it is my pleasure to introduce Mr. Stefan Keitel. He is the Chief Investment Officer of Credit Suisse. Stefan, these measures by the central banks, how effective are they in the long term?
We think that these measures, of course, should have a kind of positive influence on a sustainable basis because they are dampening the financing costs and so have a direct influence on corporate and consumer spending. They also deliver relief for the indebted peripheral countries, and that's exactly the strategy of the central banks, because this also delivers time to balance out the implementation of austerity measures, stimulation of growth, and also to implement the right and necessary structural reforms. And we should definitely also not underestimate the psychological effect, because with all these packs of measures, bundles of measures, I think trust also came back into the capital markets, risk aversion decreased visibly. Crisis management overall in the Eurozone has improved, and so there's a rising conviction that the Eurozone crisis from a long-term perspective, despite all risks, is more and more manageable.
The two biggest economic powers, the US and China, have two very different situations right now. There's the question of a soft landing in China, and there's the fiscal cliff in the US. What is the way forward here?
Yeah, on the fiscal cliff side in the US, we have to take into account that when it comes to the expiry of the tax cuts completely, plus all these spending cuts, this counts for roughly 600 billion, and this counts for 4 percentage points of US GDP in 2013. But we are strongly convinced that at the end of the day, there will be a compromise sooner or later. So the impact of the fiscal cliff from our perspective will be somewhere between 1 and 1.5 percentage points. On the opposite side, there are some positive aspects as well. So we have strong improvements in the housing market, we have visible improvements in the labor market, we have positive wealth effects, and last but not least, we have that proactive and very aggressive central bank strategy out of the Fed camp, and this should be rather a long-term story. So growth rates should be also nicely underpinned despite all fiscal cliff issues, and our prediction for US GDP 2013 in line with our research department is somewhere between 2 and 2.5%. That's not stellar, but it's still far away from a recession. A similar picture in China. I think here we had some question marks in the past because growth rates shrinked visibly and sustainably over the last 3, 6, 9, 12 months from more than 10 percentage points on the plus side to now roughly 7%. Unfortunately, there had also been a kind of inflation pressure, what limited down the proactiveness and willingness of the Bank of China to step in. But this picture now has changed because inflation rates came down visibly and sustainably. So the door is now open for additional measures out of the Bank of China camp, and that's clearly our expectation. And what we now see is also a kind of bottoming out of Chinese growth. So we expect Chinese growth somewhere between 7.5 to 8% in 2013. And that's a rather constructive picture generally spoken. And this, in combination with also a kind of a stabilizing mode in the housing markets and more clearness from the political side, this opens the door for more constructiveness on China, generally spoken. For us, is a confirmation for our soft landing scenario. And from an investment strategic perspective, we are also pretty much convinced that also for China as a region, when it comes to the equity market, this could be a buying opportunity for the future.
What does this all mean for the most important asset classes, for equities, for bonds, but also for gold, for example?
On the equity side, of course, we have to take into account that still risks are hovering around. We should not underestimate that there are still implementation risks in the Eurozone, discussion on the banking union, discussion on the third rescue package for Greece. We have that discussion on US fiscal cliff. We have that discussion about the US election. And also we have the geopolitical issues, the geopolitical tensions, in particular in the Middle East. But with all these risks, I think it's the same. They are well known, they are discussed. And when when things are well known and discussed at the capital markets, they are already minimum priced in partially into the capital markets. Though we stick to our recommendation to use market dips, correction, consolidation phases as a renewed buying opportunity and the possibility to add further equity positions. Because we should not underestimate, there's a lack of investment alternatives. We are still confronted for a long time from our point of view with a low interest rate and yield scenario. Sentiment is anything but euphoric. Valuations are compelling more or less across the board. Central banks will stay aggressive, so many reasons to stay constructive on equities from a short, medium and long-term angle. On gold, it's an easy story. I think the real interest rate, negative real interest rate scenario will stay. That's a major driving force for gold price appreciation. The current setback is healthy and also from our point of view opens the door for renewed buying opportunity later on. And on the bond side, the traditional bond market is not dangerous, but it's unattractive. Despite a yield pickup over the last weeks, months, depending on the region, 20, 40 basis points, now makes the situation a bit more healthy, but it's definitely not a big buying opportunity. Maybe we buy a bit selectively, but we stay underweight traditional bonds and we stick to our short duration strategy. We are more positive on credits, still on high yield bonds and on emerging market bonds. So as we already managed that game year to date 2012, diversification is key and should stay key with a focus on real assets and in particular on equities.
Stefan, thank you very much for these comments and thank you for tuning in. If you have any questions on what you have just seen or on Credit Suisse in general, we'd be happy to hear from you. And tune in next time. Thank you very much.